Hello everyone, this is Dr. A.G. Maithili, Assistant Professor, Department of Commerce with Finance, Dr. S.N.S. Rajeshwaran College of Arts and Science. Here I am going to speak about marginal costing. So what is marginal costing? Marginal costing is a method of costing that is concerned with change in cost resulting from changes in the volume or range of output and sales. An increase or decrease in total cost that is caused by an increase or decrease in the volume of production and sales is known as marginal cost, differential cost or incremental cost. Thus, marginal costs relate to future costs and can be determined by subtracting the total at one level of output or sales from that of another level. It should be noted that marginal cost refers to the increase or decrease in cost on account of a block of units produced or sold. The marginal cost per unit remains the same. Now coming to the characteristics or features of marginal costing. Classification of cost. Here all costs are classified as fixed cost and variable cost. Focuses on variable cost. Fixed costs remain constant. They do not fluctuate with output. By contrast, variable costs always go up or down with the output while per unit cost remains the same. Treatment of finished and semi-finished goods. The value of finished goods and work in progress is included in the marginal cost. Treatment of fixed cost. Fixed expenses are shown on the debit side of profit and loss account for the period in which they are incurred. Basis of pricing. Prices are based on marginal cost plus contribution. Thus, contribution is the excess of selling price over marginal cost of sales. Determination of profitability. The profitability of a product is determined after a close study of contribution made available by each unit of output. Knowledge, utility or merits of marginal costing. Knowledge of cost classification. Fixed costs are more or less uncontrollable and variable costs are always controllable. The cost data needed for decision making and profit planning are made readily available for the management. Simple operation. Marginal cost is simple to operate because it avoids the complexities of apportionment of fixed cost, which is readily arbitrary. No danger of over and under charges of overheads. In this cost control technique, the risk of over and under allocating overheads is minimized. Relationship of fixed and variable cost. Fixed costs are related to time with no reference to output, while variable costs are always associated with output. Thus, an increase in output will reflect how much extra funds will be available for additional output. Knowledge of minimum output. Marginal costing can indicate the minimum output required to equate fixed and variable cost. This position is known as break-even point, where cost and revenues are always equal. So it is a point where the cost equals the revenue. So it is a point of no profit or no loss. Now coming to the limitations of marginal costing. Incorrect assumptions for classification of expenses. It is assured that the expenses are grouped as fixed and variable, while certain expenses, example employees bonus, are purely caused by management decisions and have no reference to output or time. Marginal costing does not give due attention to the time factor. There are cases where the marginal cost of two outputs is the same, yet one takes twice the time to produce as the other. However, in reality, job that takes more time are more costly. Not applicable to all industries. Marginal costing cannot be applied suitably in certain industries, including shipbuilding and contracts. No fixed expenses are controllable. Marginal costing ignores the fact that fixed costs are always controllable. The technique of budgetary control can be helpful in controlling the amount of fixed overheads. Lack of calculation. Marginal costing does not provide any standard for performance evaluation. A system or budgetary control and standard costing gives more effective control compared to marginal costing. Wrong basis of stock and work in progress. Under marginal costing, stock and work in progress are valued based on the marginal cost and fixed costs are taken into account. Thus, these expenses are a lesser charge. Limited output. The study of marginal costing is suitable only to a limited extent. There is every possibility that beyond a specific limit of output, fixed expenses will show an unusual jump. Various factors affect production cost. The break-even point is affected by fixed and variable cost and a marginal cost, marginal costing technique. Thank you.